All right, dear students. So in this video, we'll be discussing the planning thing. And in the exam, you have the audit risk question from the planning area. So first of all, we'll be discussing the audit planning. I'm not going to revise the straightforward, the knowledge-based area. I'll be focusing on the case study question because regarding the knowledge-based area, you can read my notes. I'll be discussing the case study area which you have in the every exam, and the requirement is when you go to the question, using all the information provided, describe 7 audit risks and explain the auditor's response. So describe risks and explain the auditor's response. So let me split this requirement into 2. Describe audit risk, and then you have explain the auditor's response. So this is the requirement you will be having in the exam, and always you will be having this requirement. There will be no change. I have seen many students who are doing this mistake in the exam, that I don't know from where they have started this thing. But when I ask them, okay, what do you have written in this? They say we have to relate that with the inherent risk, with the control risk, and with the detection risk. And they keep wasting time in the exam in identifying inherent risk, control risk, and business, because someone has told them that audit risk has 3 components: inherent risk, control risk, and detection. That is true. Audit risk has 3 components, but in the exam, there is no need to identify that this is inherent risk, this is control risk, and this is detection risk. All you have to do is to relate the risk with the financial statements. Because the other mistake the students are doing is that they write the business risks. And I'll be giving you an example that if you are not relating a risk with the financial statement, it is going to become a business risk. And when you explain the auditor's response, remember one thing, I am telling you this point for to overcome this difficult area which the students consider it difficult. Auditor's response is simply an audit procedure. And hopefully you know what is audit procedure. And I'll be discussing that in my audit procedure video. But right now, explain the auditor's response is simply an audit procedure, and that will be same. When we'll be doing a question, I'll be telling you, look, this is same as the audit response, audit procedure. So describe audit risk. Whenever you are doing that, relate that with the financial statements. And this is risk of incorrect accounting treatment. Now, this is the thing which I have said that will make your life easier when you are attempting the audit risk question. Remember, whatever is given you in the case study, just link that thing with the accounting treatment. Like, for example, if you are looking at the question and there's something written over there, bring the relevant accounting treatment in your mind and then think opposite. Like, say, for example, when I say there's written that the management spent this much amount on the research and development. Now you have read this thing, bring accounting treatment into your mind. Okay, research should be expensed out, development should be capitalized if the criteria is met. There's a risk that research may be capitalized or the development is capitalized, but it does not meet the criteria. The assets and the profits may be overstated. Similarly, like for example, if it is written, the company has spent this much amount on the refurbishment. Now you are going to bring the accounting treatment in your mind that, okay, refurbishment is a mix of capital and revenue expenditure. Capital expenditure should be capitalized. Revenue expenditure should be expensed out. There's a risk that expenses may be misclassified. Similarly, like for example, if there is written that the management has taken the loan for 5 years, and now you will bring the accounting treatment in your mind, and okay, loan they have taken for 5 years, this loan liability should be split between current and non-current liability, and finance cost should be charged to the statement of profit or loss. There's a risk that the split of the liabilities may not be done, and incorrect finance cost may be charged in the profit or loss. So whatever comes in the case study, bring the accounting treatment in your mind. Like for example, they are saying that the entity does not perform the bank reconciliation. Now, what is bank reconciliation for? Bank reconciliation is done to reconcile the cash and the bank balance. If the bank reconciliation statement is not done, bank reconciliation is not done, there is a risk that the bank balance presented in the statement of financial position may be incorrect. So the thing is that whenever you are having anything in the exam, just bring accounting treatment in your mind, and this is the key. This is the key. Accounting treatment is the key. When you are dealing with the audit risk question, just bring accounting treatment in your mind and then say opposite. Like, as I told you, research should be expensed out. And the opposite thing is that they may have capitalized the research. Capital expenditure should be capitalized. There's a risk that incorrect amount may be capitalized. Inventory should be recorded at lower of cost or NRV. There's a risk they may have still recorded the inventory at cost rather than NRV. So the thing is, you are at the planning stage, and at the planning stage, the auditor responsibility is to take the complete understanding of the entity, and they will be looking at the things skeptically. We are not sure that, okay, this is exactly the risk. We are keeping this thing in our mind that, okay, when we are doing the audit, these are the risks which can be in the financial statement. Risk of material misstatement. That is why we call this financial statement risk. That is why we call this risk of material misstatement. And when we say risk, that means there is a chance. We are not sure about that. So that is why I am always using the term may. There is a risk that research may be capitalized. The revenue expenditure may be capitalized. Inventory may be still recorded at cost rather than NRV, because we are at the planning stage. We do not have the financial statements right now. That is why I cannot say with confidence that, okay, they have misstated the inventory. When you use have, has, this thing, the inventory is misstated, the inventory has been misstated, have been misstated. So when you're using these statements, these words, then you are saying that the inventory is misstated. You are quite sure, but at the planning stage, you are not sure. So remember one thing, that use the term may. So you will be using the term maybe, okay, because you are at the planning stage. So explain the auditor's response is simply an audit procedure. Like, you have identified the risk. Now, let me give you some example. Let's take some examples. And with the help of the example, you can understand what I am actually trying to say. Like, for example, company disposed a non-current asset. Now, company disposed a non-current asset. This is the thing written in the exam. Now, the risk. There is a risk that asset may not be removed from the asset register. Okay, so there's a risk that the asset may not be removed from the asset register. Now, this was the risk which you kept in your mind, that, okay, they have disposed the property, plant, equipment. There's a risk that is still recorded in the asset register, and they may not have removed it. The response is something when you are confirming it. So response is inspect the fixed asset register to confirm the removal of asset. Or you can simply write this response in this way as well, or you can write in this way: fixed asset register should be inspected to confirm the removal of asset. Now, you can write the response in two ways. So whenever you have the audit risk in your exam, obviously it will be, because this is somehow a compulsory question. Examiner has not stated that, but I am saying that there will be a question from the audit risk. So bring the accounting treatment in your mind and then think opposite. Now, how to write? How to write the audit risk in the exam? Because the requirement is that describe the audit risk and explain the auditor response, that means you will be making two columns. Here you will be writing the risk, and in front of that, you will be writing the response. Okay, when you're writing the risk, you will be first of all writing the case study line. If the case study line is big, make it short, but you have to write it because otherwise the examiner cannot get which risk you are writing. So you have to write the case study line. Make it short. So make it short. Then you will be writing the accounting treatment, if any. Like for example, in many examples I've stated that research should be expense out, development should be capitalized, inventory should be recorded at lower of cost NRV, loan should be split between current and non-current liability. So you have to write the accounting treatment, if any. Why am I writing if any? Because every risk does not have the accounting treatment. Like for example, the finance director left the company. This is also the risk that the other accounting team may not be sufficiently qualified to deal with the financial reporting process, and the financial statement may be materially misstated. Now, in this risk, we do not have the accounting treatment, so we'll not be writing that. And then you have to write the risk, that there is a risk that research may be capitalized, and then you have the effect that resulting in the overstatement of assets and profits. So you'll be writing in one paragraph. Case study line, accounting treatment, if any, then you have the risk and then effect. And I have described this thing in your exam requirement document as well. And response is simply an audit procedure. This is exactly the same. So now we are done how to write the audit risk in the exam. Now we are moving towards a question which is September, December 2017. And this is Prancer Construction. So this is September, December 2017. This is hybrid. Okay. The requirement is the same. Using all the information provided, describe 7 audit risks and explain the auditor's response to each risk in planning the audit of the Prancer Construction Company. Okay, you are an audit supervisor of Qubit & Co. and planning the final audit of a new client. Okay, so new client is itself a risk. Okay, Prancer Construction Company. So this is the first risk we have identified, and we'll be writing Prancer Construction Company for the year ending 30th September 2007. The company specializes in property construction and providing ongoing annual maintenance services for the properties previously constructed. Forecast profit before tax is 13.8 million and total assets are 22. Both of the higher for the previous year. Okay, this is given for the calculation of materiality, but we do not do in the F8 exam. You are required to produce the audit strategy document. The audit manager has met with Prancer Construction Company's finance director and has provided you with the following meeting notes, a copy of the August management accounts and the prior year financial statements. The prior year financial statement recognized work in progress of 1.8 million, which comprise property construction in progress as well the ongoing maintenance service for finished properties. Okay. The August 2007 management accounts recognized 2.1 million inventory of completed properties and compared to 1.4 in September 2006. The full year inventory count will be undertaken at all the 11 building sites where construction is in progress. There is not sufficient audit team resource to attend all inventory counts. So first of all, they have the work in progress. Then Their inventory in the last year was 1.4 million and now it is 2.1 million. Okay. Then they have the 11 building sites which do have the inventory and which should be counted, but there's insufficient audit team. In line with the industry practice, Frenzer Construction offers a customer a 5-year building warranty, which covers any construction defects. Customers are not required to pay any additional fee to obtain the warranty. The finance director anticipates this provision will be lower than last year and has improved its building practices and therefore the qualities of the finished property. They are reducing the provision. Customers who wish to purchase a property are required to place an order and pay 5% non-refundable deposit prior to the completion of the building. When the building is complete, customer pay a further 92.5% with the final 2.5% due to be paid in the 6 months later. The finance director has informed you that although an allowance for the receivable has historically been maintained, it is anticipated that this can be significantly reduced. Information from the management accounts, Frenzer Construction Company prior year financial statement and guest management accounts contain a material overdraft balance. The finance director has confirmed that there are minimum profit and net assets covenants attached to the overdraft. Covenants means conditions. A review of the management account shows the payable period was 56 days compared to the 87 days for the last year. The finance director anticipates that the September payable days will be even lower than those in August 2007. And now this is the case study which you have. And I told you that whenever you are writing the audit risk, bring the accounting treatment in your mind and relate that with the financial statements. Because if you are not relating that with the financial statements, then that will become the business risk. Now, I'll be writing the risk for you. So you have to make the 2 columns. And here you will be writing the risk. And in front of that, you will be writing the response. So first of all, you are the audit supervisor of Cupid company planning the audit of new client Frenzer Construction. So Frenzer Construction is new audit client. A detailed understanding of the new client is required before the audit starts. There is a risk that the audit team may have incomplete or poor understanding of the Frenzer, resulting in increased deduction risk. Now you can simply write, if you do not want to write this thing, you can simply write, there's a risk that the audit team may have incomplete understanding of the entity, and as a result, they may not identify the misstatements. Financial statement may be materially misstated. You can write in this way as well. Now the response. The audit team should take the complete understanding of the entity. Further, they should be skeptical throughout the audit, as this is first year. Now this is the response. The audit team should take the complete understanding of the entity, and further you can write as well, but there's no need to write too much, but I'm writing for you. If you forget one, you can write the other. The experienced and qualified audit team should be involved in the first year audit. Now, this is the first risk we have written. Now we'll be writing the other. Okay. The prior year financial statement recognized work in progress of 1.8, which comprised property construction in progress as well as ongoing maintenance service. Okay. There is a significant level of work in progress at the year end. Work in progress valuation requires specific skills and knowledge. There is a risk that audit team may not be sufficiently qualified to value the work in progress, resulting in the incorrect valuation. Now, you see that they said the prior year financial statement recognized work in progress, which comprised property construction in progress. So properties, a big thing to construct. They're not a small thing. So that required, like in order to understand that, okay, this property, this is this much completed and how it should be valued, there's a proper technique for that. The audit team should discuss with management the methodology or technique they use to value the in progress properties. The auditor should recalculate the work in progress using the same technique. Now, this is the second risk you have written. Okay. Now we'll be writing the third one. Okay. The August 2007 management account recognized 2.1 million of inventory in complete properties compared to the balance of 1.4 million in September 2006. The August 2007 recognized inventory of 2.1 million, which was 1.4 million in September 2006. According to IES 2, inventory should be recorded at lower of cost or NRV. The increased value may be due to the struggle to sell inventory. There is a risk that NRV of inventory may be lower than cost, but still recorded at cost, rather NRV, resulting in the overstatement of assets and profits. Like they're having a significant balance. We are having an assumption, because this is an audit risk, we are having an assumption that this may be due to the struggle they are facing in selling the inventory. So inventory value may be lower than what is the cost. So it should be recorded at lower of cost NRV. There's a risk that it is still recorded at cost rather than NRV, resulting in the overstatement of assets and profits. Now the response: detailed NRV testing should be performed on the year-end inventory. This is simple response. Now, the other risks: a full year inventory count will be undertaken on the 11 building sites. A full year inventory count will be conducted at 11 building sites. There is insufficient audit staff. It may be quite unlikely that auditor attend all inventory counts. There is a risk in the completeness and existence of inventory on the warehouse not visited. The auditor should try to gather sufficient audit evidence through other means, such as management records for the warehouses not visited. Now this is the risk. Okay. Then you have, in line with the industry practice, Spencer Construction offers its customer a 5-year building warranty which covers any construction defects. Now this is another risk. I'll be writing this as the last one, because the other one I'll be just discussing. Spencer offers a 5-year building warranty. Now, according to the IS 37. If you do not know, you can simply write according to the standard or the relevant standard. Do not write the wrong one, okay? According to the IS 37, if the outflow is probable, provision should be created. Okay, now they were saying that customers are not required to pay. The finance director anticipates this provision will be lower than last year. Now, if you are writing that there is a risk that the provision may not be created, now this is the wrong risk because they are saying that they record the provision. Finance director says that this year provision will be lower. There is a risk that incorrect provision may be created, resulting in the understatement of expenses and liabilities. Because there's nothing with the assets, because the entry of the provision is debit, profit or loss, credit provisions. So if the provision is not created, then there will be effect on the expenses and the liabilities. Every time you should not write the assets. This is something you should be careful about. Okay, then the finance director should be inquired regarding the basis of reducing the provision. Compare this year provision with the previous year. And see whether actual results were reasonable. Now this is the thing, okay? So the next is the customer who wish to purchase a property are required to place an order and pay a 5% non-refundable deposit. Now, according to IFRS 15 revenue from the contracts with customer, revenue should be recognized when the performance obligation is met or satisfied. There is a risk that revenue may be immediately recorded rather than recording it when the performance obligation is satisfied, resulting in the overstatement of revenue. Allowance for receivable has historically been maintained. It is anticipated that this will be significantly reduced. Okay, when there is a risk of the bad debts, the management should create the allowance for the receivable. Allowance for receivable can only be reduced if there is a genuine change. There is a risk that this may have been done to achieve the profit targets. The receivables may be overstated. Then they have the overdraft balance. There are minimum covenants of the profit attached. You see this line. The finance directors confirmed that there are minimum profit net assets covenants. That is why possibly they are reducing the provision. That is why possibly they are reducing the allowance, because in order to keep the loan, they have to maintain the profit targets. So there is a risk that they may manipulate the profits in order to keep the covenants, in order to maintain the covenants. Profit may be overstated. And then you have the previous days, the payable were 87 days. Now these are 56 days, and they say it will be more lower. That means they may have understated the payables. So this is the audit risk question, first question, and I'll be sharing with the other question as well. Now, whenever you are doing a question of the audit risk, just bring the accounting treatment in your mind. That's it. This was the first video related to the audit risk.